as much capital for the down payment on their next home or furnishing the home as such. So in terms of figuring out whether or not that costs justify the means, the formula is pretty simple. You're just going to take the difference in the additional cash that you're paying and divide it by the monthly payment difference as if you're not paying. So if it's $5,000 to save $150 a month, you just 5,000 divided by that 150, and that'll give you how many months until you break even.
Simple math. Gotta love it. Okay, the next way to combat high interest rates is assuming a mortgage. And I'll give you my 2 cents on it. I see different listing agents offering it, but a lot of times what happens is, there might be a lot of equity in the property. So they'll say, look, you can assume this rate at 2.6, at 3.5%. The property might be worth, let's say, $800,000, but the loan is at $600K. So it's like, oh yeah, you can assume it, but you have to bring $200,000 to the table to make up for the difference. So this is something I see advertised a lot, but I don't see a lot of people doing it. I think in the perfect scenario, it could work, but I just don't see it happening too often.
Assumable loans is one way in which you could reduce the interest rate and payment, but there are a lot of hoops that you're going to have to jump through. You alluded to it. You kind of hit the nail on the head with, you see it advertised a lot, but you don't hear much successful, stories about it. And that's just quite simply because of the amount of little intricacies that come with it that aren't advertised, that a buyer is going to find out once they're knee deep in it. Making up the difference is one thing. A lot of people advertise a VA assumable. One of the main awesome attributes of a VA loan program is being able to do 0% down. With an assumable VA loan, like you said, with a bunch of equity, that doesn't work. The other key thing is with the assumable loans is you have to go through the servicer of the current loan, of the seller's loan. So if you're buying and if you're working with me for your pre-approval, but you come across a property that is offering a assumable loan, you want to pursue that, we are not going to be able to work. You're going to have to work with whoever that lender is. And in most cases, it's a large bank, credit union, and they are great institutions, right? But their resources are not all directed necessarily towards the mortgage. So what we have heard and what we have seen in terms of those turn times is closer to 60 days. And there is a lot more paperwork and a lot more unique qualifying aspects involved. So if you come across that and if you're interested in it, definitely reach out to the seller, and you need to be connected with the seller's servicer/lender to get all of the information as much as possible.
Yeah, I've heard agents who've closed those recently say it takes about 90 days, and it's just kind of a stressful process. But at the same time, you should keep a lookout for those, because I'm sure people have gotten some amazing deals that way. You shouldn't just count that you're going to find something like that. Kind of like a needle in a haystack type of deal. The next way to combat higher interest rates would be down payment assistance programs. And I actually don't see those too often. You'd probably obviously have some more info on that, but I don't see those too often. I mean, sometimes builders will offer things, but I don't know. What are your thoughts on that?
So this is what, number five strategy. So down payment assistance programs. I think this is going to jump up the list in terms of if we're going to rank the quality, or at least the amount that this is probably going to come up with the new buyer agency, more first-time home buyers, certainly in this market. There are a plethora of down payment assistance programs out there. And I like to qualify them. There are national programs that you can take advantage of. There are state programs that you can take advantage of. So DC has different programs compared to Virginia and Maryland. And a lot of their differences come with most first-time home buyer programs and the down payment assistance. They're all based on income and what the household income is, or now qualifying income for those buyers. So they're going to vary, obviously, based on the income levels of what you're looking at. But we've started seeing, and we're going to start seeing more utilize down payment assistance to not just help with closing costs, but it can also help if you're doing we have a client currently doing a 100% VA loan, but they also qualify for a $12,500 grant. That covers all their closing costs. So they really don't really need to put much, if any, into the transaction right now, but they have some money that they would like to use, and they're going to use that money set aside to buy down the rate. So that's, from a down payment assistance, it's going to not just help with the closing costs, but as for our topic and lowering the interest rate and your payment, that's going to be a way in which those grants and down payment assistance loans can be facilitated, because it doesn't just have to go to the closing cost. You can also use some portion to buy down your rate.
Interesting. Okay. So as far as down payment assistance programs go, always reach out to your lender, reach out to Rich, because they're always changing. There's different updates. There's different nuances depending on incomes, areas. I see them for condos in DC sometimes, but reach out to your lender for that. Number 6, having a higher credit score can help obviously lower your rate. Having a higher credit score is just what you should do anyways, but it can also lower your interest rate.
Yeah. So this is up there with the down payment. So one of the top ones, right? Having a higher credit score is certainly going to impact the interest rate. The minimum credit score for most programs is 620. The minimum top tier, if you will, once you reach 740 or above, you were considered top tier and you were going to get the best rate. Fannie and Freddie for conventional financing have now amended that, and they've increased that and added separate individual buckets in terms of credit scores now being impacted by tiers of 20 points. So 620 to 639, 640 to 669. So 20 point increments all the way up can have a slight effect on your interest rate. So the better, obviously, the better the interest rate is when it comes to your credit scores.
Okay. Number 7, renting out part of your house. And this obviously is not like directly correlated to interest rates, but this can help with your payments. So you could we have a video we're doing about 5% multifamily. So you could live in one unit and rent out the other 3, and that could help lower your monthly payment. You could do an Airbnb suite. You could rent out your basement. You could do a lot of different options.
Right. So having an additional usage of your home, or border income, if you will, renting out a room, right? That's not necessarily something that's going to go into qualifying or affecting your interest rate, but it will affect your payment, right? How much you're paying versus how much you're renting it out to another individual, helping with your cash flow, right? A lot of cases, this happens, and we all have the client, they're buying the home, they are able to handle that mortgage payment, but they have intentions of another individual, friend, what have you, moving in. They're not contributing to the loan qualification, but they're going to be moving in, and it's additional income that client, that particular renter or what have you, will be able to provide additional cash to help with the payment. So it reduces the money out of pocket for them.
Yeah, and I mean, even just $1,000 per month, that's $12,000 per year. That's pretty significant. And there's so many apps nowadays too, where you can like rent out your storage space, your garage. You can rent out your pool. I've seen one of those. You can rent out pretty much anything. I think people rent out, if you have like a scenic looking house, that people can rent it out for photo shoots, video shoots, things like that. The next one, number 8. So seller concessions for temporary buydowns.
Yes. So seller concessions have been, in this current market, it's been a buyer friendly, so able to negotiate seller credits. And in the past, the common use was to apply them to reduce your closing costs, right? Or doing what we talked about earlier, a permanent buy down. Now, with the higher interest rate market, temporary buy downs have become a very attractive product for both seller and buyer, quite honestly. But how it works for the buyer, it is taking that seller concessions, and they are going to be, the funds are set up in a separate escrow account, interest-bearing escrow account that pays a portion of the interest payment for the buyer. So a 2-1 temporary buy down. The 2 stands for how much lower the interest rate is compared to what your 30-year fixed rate currently is. So if the current interest rate is 7%, that 2-1 buy down for the first year the interest rate is 5%. And that payment that you're making is based on 5%. The second number, 121, the 1 stands for the second year of your loan. It is 1% below that market rate. So it was 7%. The first year is 5, it's 2%. The second year it's 1%, so it's 6%. So for the first 2 years, you have a much significantly lower payment and rate paid for by the seller, and then once you arrive to year 3, it returns to that 30-year fixed rate that you have. So in this example, it was 7%. So it's not like an arm where it's going to adjust. It's still fixed. It's just the seller is paying interest for you, a portion of it, for the first 2 years.
Gotcha. And I do see that quite a bit where different listing agents are offering 2-1 buy down. Is there a 3-1 buy down or like a 5-1 buy down? Or is it, well, obviously not 5-1, that'd be pretty extreme, but
there's we offer a 1-0, so it's just 1 year, or 2-1, which is 2 years.
Okay.
There are, I've heard some out there are 3-2-1. So 3, you follow with the 3% below. But anything beyond that, I have not heard. But again, it's a creative way to combat the higher interest rates right now, and sellers are more willing to negotiate because of just the light demand. And
a buyer could do this as well. It's not just a seller that is offering. Like a buyer could say, "Hey, I want to do a 2-1 buy down," and talk to you about it. Or is it?
So I'm glad you brought that up.
Yeah.
So the answer is actually no.
Oh.
The buyer can buy it down, just the normal buy down, but the temporary buy down has to be fully funded by the seller.
Oh.
So it's important, and the amount is calculated based on the loan amount financed, and then also what your the 30-year fixed rate is at that time. Okay. So it is a calculation. So it is important. And as we did together on a previous transaction, when identifying a property, and if we're looking at that, knowing exactly what the down payment is going to be, and then knowing exactly what the rate is, so that the lender then can provide you, the realtor, and the client what that number needs to be, right? Yeah. The concession amount. Right. It typically averages from about 2% to 2.5%. That's a general rule of thumb that I would say as a realtor expect. If we're doing the buy down, it's going to be about a 2 to 2.5% concession based on the price.
Gotcha. Okay. That's good to know. Number 9 ways to combat high interest rate. Don't max out your budget. Just because you're approved for $1 million, you don't have to spend it all.
Yes. That's an obvious one, right? Is, don't take it all the way to the absolute max, right? The key thing to understand when it comes to qualifying, lenders, we go based off of your gross income, right? Not the tax deducted income. So you understand when you get your pay as a client, you get your paycheck after the deductions, what your take home pay is. We're going off of that higher amount, right? We're also only taking into account federal debt. So that's student loans, credit cards, any other installment loans. But that's about it. Your utility bills, phone bills, gym memberships, those type of additional expenses are not taken into account. So it's always important when working with a lender. Yes, you want to identify your max buying power, but you also want to identify your comfort buying power, what your comfort levels are, and having those lenders provide you breakdowns of those payments so you can connect those dots and understanding of what you're going to feel comfortable with, right? We don't want to be, we want to allow you to go out and have dinner with friends and enjoy the nightlife, especially if you're in DC. The nightlife is awesome, right? But you don't want to be stuck to where all of your paycheck is going to the house.
Yeah, I think I just saw a meme where it was like the person bought their first house, but it was like, they had no money left over, so they're just sitting in a vacant house. And so you don't want to be that person. You can buy a big house, but have a little bit left over. Don't max it out too much. The next way, number 10, is to make additional payments on your loan to pay it down faster. If you make one additional payment per month or per year, that can cut off like years off of your loan, and you can get your house paid off pretty quickly.
Yeah. So this one, the additional principal payments, right? This is certainly an option to save you over time. It's not going to affect your interest rate at the time of purchase, but the general rule of thumb is if you make one extra payment a year, so 13 payments out of a 12-month year, that will shave about 5 to 6 years off of your loan. So it goes from a 30 to a 25 or less, maybe even more. So we've seen clients, with that intention, and it's certainly, again, only one payment. You do more, that could obviously translate to more. So that is definitely something that can save you interest over time, but it doesn't necessarily affect your interest rate. The alternative is if you want to reset your payment, they have, we just talked about the smaller additional monthly payments, but if you come across a large lump sum, whether you sell another property or bonus or what have you, and you have a large chunk of change that you want to apply to the home, you can do that as a recast or a large lump sum principal curtailment. And that it won't change your rate, but it will reset your payment off of that lower new balance and the interest rate. So that will immediately impact and lower your payment.
And they would talk to you about this if they wanted to do a recast or.
They will, if your loan is with us, yes, you reach out, whoever you're making the monthly payments to you reach out to them for the recast. A recast is not a refinance.
Yeah.
So it's much less costly. Like I said, it doesn't affect your rate. It just resets your payment now at a much lower balance based on how much you apply as a large lump sum.
Gotcha. Okay, cool. And then the last one is you guys have a refi program for people that close loans with you guys.
Yes. So ACM has our refi or Rate Saver Plus program. This is for a lot of the buyers this year that were hesitant, mainly just because of the interest rate. So for those that are seeing houses that are checking all the boxes, but the limiting factor on making a decision to pursue that offer is the interest rate. Well, if you qualify for the loan and you close with us, we will then offer a 2-year window from the date of your closing to refinance with us once rates do relax. And when doing so, we will waive all of our origination fees. So it's definitely an incentive to not wait. As we know, as I'm sure you've done some videos on, the cost of waiting. Values in DC and the majority of the DMV, they don't drop. And they're just going to steadily progress. And then if we wait till the spring market, that's another large pool of buyers, which drives up competition and price bidding.
So you'd basically be protected for like 2 years to get almost like a free refinance. There'd be some costs associated with, but not the majority of the cost.
Yeah, so you'll have your refinance costs like the title and recording fees, but our lender fees are completely waived.
All right, so if you're looking to buy in the Washington, D.C. area, Washington, D.C., Northern Virginia, Maryland, reach out to myself. I'd love to assist you. I have a team. We can help you out almost no matter where you're looking in the DMV area. And then Rich is licensed in a whole bunch of states, Florida, North Carolina, up and down the East Coast. And we also have different referral partners. So if you're looking somewhere else in the U.S., we can put you in touch with a great agent and a great lender as well. And be sure to check out some more of our videos. We're going to be doing a lot more of these.